Okay, guys. Today we have the pleasure to have the lecture of Stephen Shan. Stephen Shan is an assistant professor at the American University of Sharjah, I guess. I don't know how to pronounce it well.
Sharjah.
Sharjah.
Yeah.
He was awarded the EPSRC Doctoral Prize Fellowship in 2016 at the University of Manchester, UK. His research areas include extreme value analysis and distribution theory in analyzing financial commodities data, blockchain, and cryptocurrencies data. He co-developed and co-wrote on our package entitled VARES for computing value at risk and expected shortfall. He is a co-author of the book Extreme Events in Finance, a handbook of extreme value theory and its applications. So now, today, we'll have the pleasure of having the lecture entitled Bitcoin versus High Performance in Technology Stocks and Diversifying Against Global Stock Market Indices. Thank you, Stefan, for taking this time and giving this talk to us today.
Okay. So yes, good afternoon, everyone. And firstly, I'd like to say thank you very much for Vera, Diane, and Michelle for inviting me to present at this local webinar today. So today I'll be presenting some of my latest research or paper that I'm doing, which is on Bitcoin versus high performance technology stocks in diversifying against global stock market indices. Okay, so this paper that I just submitted is kind of more financial based, but again, it's still got some statistical methodology inside it. So bear with me, maybe a bit financial based, but yes, there is some statistics inside as well. Okay. So a quick outline of my talk today. I'll give you a quick introduction, and then I will explain about the data sets that I've been using in this research. Then I will talk a bit more about the statistical methodology that I've used to analyze this data set. And I'll finalize with my main results, discussion, and conclusion that I have gained. Okay. So introduction. So I'm sure all of you have seen lately in the news all about what is cryptocurrency. A couple of years ago when I came there, I gave another talk, which was a statistical analysis of Bitcoin. Back then it wasn't as big, but now you have seen it in the news. It's really has taken off, and also its price has really taken off as of recently. So just to make sure you understand what are cryptocurrencies, the best way for me to explain it is it's literally a digital currency that can be treated like any other fiat currency. And it's kind of like it's built on the blockchain technology, and it is decentralized. Well, the majority of cryptocurrency are decentralized with the exception of a few, okay? So the question is, why suddenly in the last 3 or 4 years has there been so much research in or studies on cryptocurrency? Well, I would like to illustrate this from an academic perspective. Why? Well, firstly, there's been an increase in global interest in the last couple of years through the publicity. Well, recently, as you've seen from Tesla, investing a lot into Bitcoin, which really has caused the latest bull market run in the cryptocurrency market. And also, there's recently a lot of technological advancements, such as, I'm not sure, have you seen in Brazil, the boom of NFTs, which is the non-fungible tokens, and also of decentralized finance, DeFi. So with all these advancements in the blockchain technology, this really has led to quite a lot of researchers, especially finance and economic researchers, wanting to understand more about the properties of this new financial assets. Hence why there's been an increased study in terms of global interest. Another reason I like to say why there's suddenly been a sudden increased study of cryptocurrency is relating to the price volatility. If you compare to normal financial assets such as FTSE or FX index, stocks, commodities, these are volatile, but when you compare it with cryptocurrency, they're not, you can't compare it with the price volatility. The volatility of cryptocurrency is more like 10, 20 or 30 times more volatile than regular financial assets. Okay, so a lot of people have been recently researching how cryptocurrency or Bitcoin can be used in diversifying the risk in portfolio management and stuff. So that's another area that has been really hot in research. And finally, which this is a kind of a newish area, is the regulation. As you know, there has been a lot of large frauds, hacks, and criminal activities on cryptocurrency and exchanges. Hence, this has really led to quite a lot of regulatory bodies bringing in new regulations on cryptocurrency and exchanges. Hence, this really has brought in a lot of research in about the importance and studying these new regulations on the cryptocurrency and also on exchanges. Okay. So the main focus on my paper today, well, I mainly focus on Bitcoin. And the main question or main research question that has been on Bitcoin in finance or economics or even mathematics is, should Bitcoin be classified as a currency or an asset? So to answer these two questions, firstly, let's focus, can anyone or can we classify Bitcoin as a currency? Well, in finance, to answer this question, a currency has to satisfy three constraints. It has to be a medium of exchange, a store of value, and a unit of account. If it doesn't satisfy these three criteria, then you can't classify something as a currency. Okay? So there has been quite a lot of research, especially as I illustrated here, by Yermak, Polaskit, and Surprise. They have did a quite in-depth analysis into these three criteria. And at the end, their conclusion in their papers is that Bitcoin can't really be classified as a currency because it fails some of these three criteria. And the main reason why Bitcoin fails as a currency really is because, as you can see, the volatility or how volatile the price is. Hence, really, these three research, if you read a bit more into these three papers, it shows you that Bitcoin really can't be treated as a currency. Okay. So the next thing in finance is Bitcoin as an investment asset? So when we talk if an asset or financial asset is an investment asset, we're really talking about, can it diversify and hedge financial risk? This is what we mean in finance when if something is an investment asset. Can it diversify or hedge? On top of that, we're really talking also about, is the investment asset a safe haven? So these three words are really the main definition that we have to answer when we're talking or assessing if something is an investment asset. Okay, so just to make sure we all understand these three main key words, I have defined it here. So if a financial asset is a hedge, then what it means is that that asset is uncorrelated or negative correlated with another asset. Okay, this is what in finance we mean as a hedge. If we're talking about a diversifier, so if a financial asset is a diversifier, we're saying that that asset is positively correlated with another asset. Okay, and finally, a safe haven, which I expect quite a lot of you have heard of the word safe haven, typically associated with gold, is when an asset that is uncorrelated or negative correlated with another asset or portfolio in times of market turbulence or booms or busts. Okay, so what I'm going to do in this paper or in this talk later on, I'll classify, can we say Bitcoin is an investment asset and does it satisfy a hedge, a diversification or diversifying, or a safe haven? So we'll answer these three criteria later on in my talk. Okay. So now a lot of financial literature has been exploring the diversification benefits when adding Bitcoin to a portfolio of stocks, commodities, FX index, gold, or oil. But what I've found when I started doing research in this area on diversification diversification of Bitcoin to portfolio is that there's not much research that has compared Bitcoin as a technology. And if you think about it, Bitcoin can be treated like a technological product because it's built on a blockchain. So how I'm going to check and can we think of Bitcoin as a technology, I'm going to compare Bitcoin as a to technology companies or high performance technology companies. And the 5 technology high performance technology companies that I'm going to use to compare Bitcoin as is, we call it as the FANG stocks. So the FANG stocks are tech companies such as Facebook, Amazon, Apple, Netflix, and Google. So in this talk today, I'm going to show, is Bitcoin or can Bitcoin be compared to as these high performance technology companies, in other words, these FANG stocks, okay? To answer this first, inside this paper, I had literally listed quite a lot of similarities in properties between these FANG stocks or these technology companies with Bitcoin. In my paper, I listed actually a lot more, but here I just listed a few, okay? So firstly, if you think about the price, comparing the stock price or the technological company stock price with Bitcoin's price, okay? So as you can see here, this is just a plot that I just taken off offline of the performance of these FANG stocks, okay? So if you have a look here, this purple line is, here's 2010, here's 2018, and you can see for the last 8 years, the S&P 500 has gone up or has increased, but only has increased 412%. When you compare this with the FANG stocks, these technological stocks, as you can see here, you can see these technological stocks has increased much more, with Netflix increasing up to 6,450% since 2010 as the baseline, okay? So this is the increase in the stock price of these technological firms. So if you compare it with Bitcoin, let me give you an example. I haven't drawn it here, but let me illustrate it. Well, Bitcoin, well, in 2013, it wasn't that much. It was around $50. And then in 2018, it rocketed, kind of similar movement to these FANG stocks, up to 20,000 US dollars. So the trajectory of the price movement of Bitcoin really followed that of these FANG stocks, peaking at early 2018 at $20,000. So if you compare 2013 price to what I just stated at 2018, this is kind of like a 1,500% increase since 2013. So again, if you follow the same trajectory, you can see that the price of Bitcoin also increased like these top FANG companies, okay? Again, as you all know, later on in 2018, in February, Bitcoin suddenly plummeted in price down to 7,000 US dollars. Again, you can see this is similar to these FANG stocks. These FANG stocks in early 2018, it also plummeted a lot. So if we're thinking about the price or price comparison between these FANG stocks and Bitcoin, they actually follow the same trajectory, okay? So this is one comparison or similarity that I found of these FANG stocks or technology companies with Bitcoin. Another comparison is this. Well, Bitcoin and technology companies have their fair share of investigation by regulatory bodies or regulations. Let me talk about Facebook or these FANG stocks. Well, in early last year, Facebook was part of this Cambridge Analytica data scandal. Amazon itself had their issue investigation on monopoly and anti-competitive retail behavior. And Google, again, last year had their fair share of problem with Google advertising investigation, okay? So you can see these FANG stocks had their fair share of investigation with regulatory bodies and stuff. If you think and compare this with Bitcoin, again, Bitcoin still today has a lot of cyber frauds. It has a lot of hacking in the cryptocurrency exchange. So in terms of regulatory bodies, both these FANG stocks and this Bitcoin have their share of focus by regulatory bodies and investigations. So that's another way I have compared it, and I went in a bit more detailed in my paper, but here I just summarized the main results of the similarities in terms of regulatory or regulations. Okay. Finally, another way you can say how Bitcoin and technology companies or products are kind of similar is through technological updates. If you think of, let me talk about Apple or normal traditional technology firms. Well, every year they have the new generation updates like Apple. Every year you have the new Apple products, which is like an improvement of the previous generation of the technology. If you think about this, this is kind of similar in Bitcoin. How? Well, Bitcoin regularly updates its blockchain system through, I'm not sure, have you heard of forking or splitting? What this does is literally the blockchain system improves, and it improves the transaction speed and the other properties of the blockchain. So if you compare these two technological updates, well, Bitcoin and these traditional technology firms both share these latest technological updates. So that's another way you can compare how Bitcoin and traditional technological firms are kind of similar in terms of technological updates. So these are just 3 similarities. Inside the paper, I have researched and listed about 5 or 10 more different similarities. So if you want to know more about it, as I say, I'm happy to share it later on, okay? So, okay, let's now move back into the main purpose of, or motivation of my paper. So the main motivation of this paper is, should Bitcoin be treated as a technology? And if so, or if we can treat it as a technology, can it be treated as a high-performance technology stock, such as these things which we call FANGs, so Facebook, Apple, Amazon, Netflix, Google, and so on, okay? So what am I going to do in this talk? Well, I'm going to explain to you, can they diversify against the risk from global stock market in both economic upturn and downturns, okay? So the main contribution of the talk today is I'm going to investigate, or I'm sorry, the main contribution of this paper is to investigate and compare the diversification properties of Bitcoin and high performance technology stocks, and how effective are they at hedging against global stock markets, okay? And finally, the results I've found is that it does, or there is evidence in diversification benefits of Bitcoin and these technological stocks when you add it into a portfolio for hedging against these global stock markets, okay? So firstly, let me illustrate the data that I've used, okay? So firstly, if we talk about the cryptocurrency data, I use Bitcoin data, and I use Bitcoin versus the dollar, the Korean won, and the euro. The reason why I chose a range of different Bitcoin currency that I'm testing it with is for robustness, because you don't want to just test it with Bitcoin US dollars. You want to make sure that your results is robust, even for the Korean won and for the euro, okay? That is why most of my research, I always use a range of different cryptocurrency versus different exchanges, sorry. Secondly, I collected these FANG stocks returns, Facebook, Apple, Amazon, Netflix, and Google. And finally, I collected 9 different stock market indices, so from a range of geographical areas. So from America, I chose the S&P 500, Dow Jones, and the NASDAQ. For Europe, I chose the FTSE 100, the DAX, and the CAC 40. And for the Asian stock market index, I chose the Hang Seng, Nikkei, and the Shanghai Stock Exchange. Okay. And these data was all daily prices, and it's from April 2015 all the way to August 2019. Okay. So the preliminary analysis that I did, just to check, was a typical, as you all know in statistics, is a Pearson correlation coefficient matrix. So for testing all the pairings between the returns of Bitcoin, the 5 FANG stocks, and the 9 global stock market indices. So I'm just really testing, do these pairs have any, what are the correlations? Okay, so how to interpret this diagram? Well, as you can see here, you have a heat map here. So if the area is darker red, we reiterate this as having strong positive correlation between the pair. If the area is darker blue, as you all know, we reiterate this as stronger negative correlation between the pair. Okay. So if you look at this diagram, what can you see? Well, let me look at here first. This area in the middle. I hope you can see my mouse here. You can see this area. So if you look at these FANG stocks, these technological stocks, we can see that they are kind of semi-strongly positively correlated with the different stock market indices, but more specifically, it is really positively correlated with the US stock market, such as the Dow's, S&P 500, and the Nasdaq. Well, we kind of expect this to be strongly positively correlated because if you think about these technological stocks, they're actually subsets or subgroups inside the US stock market, so you kind of expect there to be correlated. Okay. However, if you look at Bitcoin is actually not at all correlated with the FANG stocks here or any of the stock market indices. As you can see, the value is quite nearly next to 0. So you can see there's no really any correlation between Bitcoin's returns and FANG stocks and also the stock market indices. Okay. But what you can see here is that if you focus on the Bitcoin Korean won and the Bitcoin in euros, they kind of have a semi-strong correlation. Other than that, we don't really see much correlation based on this correlation matrix between Bitcoin and the other FANG stocks and the stock market index. So again, this is just for preliminary. I drew out this correlation matrix. Okay. So now going to the main bulk of this research is I have implemented different statistical regression methods to try to understand a bit more on how Bitcoin and these FANG stocks are used or how well it is at diversifying against these 9 different stock market indices. Okay, so the most basic regression model one can do, as you all know, is the standard linear regression model, which is the OLS, the ordinary least squared method. So here what I do is I set Bitcoin and these FANG stocks as the response variable or the dependent variable. And so we denote it as the RT. We set the independent or the explanatory variable as the index here. So these are the global stock market indices. And we fit the OLS regression onto this, and you'll see the result later on. Okay, so the OLS regression, what does it do? Well, if you didn't know, it computes a general or average relationship between the dependent and the independent variable that I just illustrated just then. Again, we all know that this is kind of the most simplistic regression model one can do, and it has a lot of flaws. And one of the main flaws is this: it's not sufficiently, or it doesn't really help you to compare the relation between the independent and the dependent variable at different quantiles. So it really just gives you an overall or general understanding of your data set. So this is one of the main downfalls of this basic standard linear regression model. Hence, this is why we moved on to the second type of regression model we use, which is called the quantile regression model. So this quantile regression model was proposed by Cochner and Bassett in 1978. This model provides a greater flexibility in analyzing the relationship between the upper and lower quantile, and it's slightly different. Again, the response variable RT, we denote this as later on fitting Bitcoin returns and FANG stock returns, and here the independent or explanatory variable, we set it as the global stock market. So the main difference in this quantile regression is we're now comparing these independent and dependent variable at fixed quantiles. So these quantiles are going to be fixed. So let me give you another analysis to understand this better. So we're caring now to see what is the relationship between the worst 10% case of the returns of a global stock market indices and the relation to that of the worst 10% case on Bitcoin or FANG stock return. So instead of caring like what happened in the OS regression, overall data, we're caring the relation at fixed quantiles. Okay. Again, the theta here denotes as the conditional quantile. And you all know that the quantile is bounded between 0 and 1. Okay. So how I fit this quantile regression onto my analysis later on is I use the R package QuantReg. So it's a free package, and if you want to practice fitting quantile regression, I do suggest you to use this package. It's quite useful. Okay, and this is what I use for my analysis. Okay. Again, this quantile regression has its limitation. So what happens is I extend this method to one of the latest method, which is called the quantile-on-quantile regression. So this is kind of like the latest regression model proposed by Sim and Drew in 2015. Again, this regression model is an extension to what I stated before, the quantile method, allowing the regression model to account for the quantiles at both the dependent variable and the independent variable. So what happens here again, your RT here is the Bitcoin returns or your FANG stocks. Here is just your index. But what happens here now, because it's called a quantile-on-quantile regression, you can have different quantiles. So for your response variable, like the Bitcoin and the FANG stock, we set the quantile as theta. So theta denotes the quantile of your response variable, which was your Bitcoin or your FANG stock returns. Your tau parameter now relates to the quantile of the stock market indices. Okay, and this is the overall formula after you derived it and simplified it. Is the return is called the quantile regression model. Okay, so what this really provides, it provides a more complete picture of the relation between Bitcoin and stock market indices return over the whole distribution. And again, let me illustrate what this really shows you now. Well, it gives you a more detailed analysis. So this quantile-on-quantile regression now allows you to compare the relationship between, say, the worst 10% case of the stock market returns. How does it relate to the best 10% best scenario of Bitcoin and the FANG returns? So can you see? Now you can compare different quantiles between your explanatory variable and your response variable. So this is one of the latest, regression model. I'm not sure if you've seen it before, and it's the quantile-on-quantile regression. Okay, and this is what I will be basing my conclusion on, is based on this quantile-on-quantile regression. Okay, so as I say, this is mainly an application paper. So mainly applying these three different type of regression models onto Bitcoin returns, FANG stocks, and the stock market indices. These are the results that I've got. Okay. So firstly, I'd just like to reiterate the results I got when fitting it using the OS regression. As you can imagine, if I set because remember, I did Bitcoin USD, Bitcoin Korean Won, Bitcoin Euros, and then I had 5 different FANG stocks. So these are all your response variable. And then I had 9 different stock index returns. So overall, fitting this OS regression, it literally related or resulted in 72 different estimated equations. So inside the paper, I've listed the majority of it, but as I say, I didn't want to list all of it in this slide. So I reiterated and illustrated the main one. So for the Bitcoin, I just illustrated here the Bitcoin USD result versus 3 different three different stock indices returns. And then for the FANG stocks, I just chose Facebook and regressed it on these 3 different stock index returns. Okay. So what is the main results that I found? So if we look at if we set Bitcoin USD as the response variable, and these are as the independent variables, what we found was as follows. We found that the returns of the S&P 500, FTSE 100, and the Nikkei has an insignificant effect on Bitcoin USD. So you can see by the coefficient is kind of small and near zero. But as I say, I haven't shown you here, which I have on my paper. I also have the R output, and you can see the p-values are not significant. So you're really saying the model is not reliable and not significant, these variables. So really, the returns of these stock index returns is insignificant if they're effective on these Bitcoin USD returns. And again, same results were seen on Bitcoin Euros and Bitcoin Korean Won. Okay. If we look at the results of Facebook as a response variable and compared and regressed it on the stock index return, we can see a slight different result. For the regression result of Facebook, well, it indicates that the return appears to have a positively, as you can see here, just looking at the coefficient, and significant effect on the S&P 500, the FTSE, and Nikkei. And again, on my R output, you can see that the p-values are kind of significant for these coefficients. Okay, so based on this OS regression, it kind of reiterates the same results that we saw back on this correlation matrix or Pearson correlation coefficient, okay? Which was the result that Bitcoin didn't have much correlation with either the stock market indices, but we did see that Facebook did have some quite strong or semi-strong correlation with the stock market indices, okay? And this kind of reiterates the same results that we saw or can see on this OS regression. Okay. Now, let me move on to now the results from the quantile regression. So this is the quantile regression when I set the response variable RT to be Bitcoin USD. Index, well, I chose, again, it can be either the FTSE, Nikkei, or S&P 500. This relates to the results of these different lines. And remember, the quantile regression is how does it affect or how does it change relating to different quantiles? Okay, so the x-axis here is the different quantiles, and the y-axis here is the coefficient of this explanatory variable. Okay, so what can we see? Well, you can see that for low quantiles, or for the majority of quantiles here, that the coefficient is kind of stable and close to zero. However, so this is kind of the same results that we saw in the OS regression. However, from this quantile regression, we see a bit more. And what we can see is that at the upper or at the extreme quantile, we see that an increase, that there is at the upper quantile, sorry, that there's an increase in the coefficient parameter of FTSE 100 and Nikkei, but there is a negative decrease in coefficient of the S&P 500. So this result could not be seen using the OS regression. But as you can see, by just running the quantile regression, we can see a bit more result and see that at the upper extreme quantiles, that every unit increase in the FTSE 100 and Nikkei, this will lead to an increase in the Bitcoin USD returns. But every unit increase in the S&P 500, it will lead to a decrease in the Bitcoin USD returns at the upper quantile. So this is something that could not be seen on the OS regression, but as you can see here, the quantile regression can see it. Okay. Again, now I compare the results now with Facebook. So now I set Facebook as the return variable, and again, the index I set as the FTSE 100, Nikkei, and S&P 500. Again, here I see a bit more, or see a bit more than what I saw in the OS regression. Again, at the lower quantile, and everything in from 0 to nearly the upper quantile here, I can see the coefficient of phi1 is kind of quite stable and positive to 0. But again, I do see something different now. It is at the very upper quantile, there appears to be a really sharp change in theta 1 for, now it's the opposite way around, for S&P 500 and Nikkei, but there is a really sharp decrease in the coefficient for the FTSE 100. Again, this kind of result could not be seen in the OS regression, but yet we can see it in this quantile regression. So as you can see, as we move along in these two different methods, we see slowly a bit more especially in this quantile regression, at the upper extreme. Okay. Finally, I'm going to now show you the results I got when fitting the quantile-on-quantile regression. Again, the quantile-on-quantile regression now, as I mentioned before, is kind of the best regression, because what happens now is you are now modeling different quantiles of the response variable, compare it with the explanatory variable. So you're comparing the different, like the worst 10% case of Bitcoin or FANG stock with, you can compare it with the best 10% case of the stock market indices. So how do you interpret this graph? So when you run that regression and plot out the results, this is the kind of 3D figure you get. So how do you interpret it? So let me first interpret this part, your tau. Remember what I said before, your tau parameter is literally your quantile for your explanatory variable. So in this case, your explanatory variable, say, as I mentioned here, is your stock market indices, and I'm representing the S&P 500. So your tau is your quantile returns of the S&P 500. So a tau value of 0 literally is the worst scenario case of the returns of the S&P 500. So this really relates to like a bear market in the financial market. And a tau value of 0.8 or nearly 1 represents the best scenario case in the S&P 500 market. And this really relates to like a bull market in the market. Okay, so this is what tau stands for. Okay, the value of theta, again, it is the quantile of the response variable. And what is the response variable? Well, in this case, we're caring about the Bitcoin USD returns. So a theta of 0, again, this represents the worst scenario case of the returns of Bitcoin in terms of in a bear market, and a theta value of 1 represents like a bull market, like what we have now of Bitcoin USD returns. Okay, so this is what the tau and theta represents, the two different quantiles. And this axis here is the beta 1 estimate. So this is the coefficient of your stock market indices. In this case, it's the S&P 500. Okay, so what does this, or how do we interpret this diagram? So let me start with here. So remember, theta represents Bitcoin USD. So if I look at here, at this point, I hope you can all see my mouse here, theta equals 0. So at the lower quantile of Bitcoin USD returns, this is like a theta of 0. What you can see here, at theta equals 0, at all tau values, at all tau quantiles, we can see that beta 1 is all large and positive. Can you all see that? So when theta equals 0, at all tau values, we can see the beta 1 estimate is all large and positively. So what does this mean? I'm sorry. So this really means that when Bitcoin return acts really poorly, so does the market return is also positively related to Bitcoin. So the market also acts really poorly. Okay. However, if we move now to like theta equals 0.5, so this is like at the median quantile of theta 0.5, we can see at all tau value that is kind of flat here. And this shows you that the beta 1 really kind of looks like it's close to 0. So what does this mean? So this means that when Bitcoin is neither at the extreme markets, like the normal market, when it's not a bull or bear market, the stock market really has little movement. Okay, you kind of expect this in traditional financial assets. Okay, however, what you do see in here is when there is a bull market, or when the market in Bitcoin is really increasing, like what we see now, for all quantiles of tau or S&P 500 returns, we see that the beta 1 is negatively and small. So what does this mean? This means that when the returns of Bitcoin is really good or really well in a positively market, we see that the S&P 500 market is negatively related to Bitcoin USD. So what is this really saying? So this is saying when Bitcoin is really increasing, because now the S&P 500 has a negative coefficient, it's saying is negatively related. So it's saying that the S&P 500 will decrease. And this is kind of what we saw last year during the COVID period, when there was a sudden increase in Bitcoin price, but yet the stock market wasn't really increasing. It was going the other way. So based on this quantile-on-quantile regression result, or this plot, one can really say in terms of financial definition that Bitcoin really acts more of a hedge, diversifier, and a safe haven against S&P 500. Okay, and as I said here, this is just one of the quantile-on-quantile regression plots that I've plotted. Literally in my results, has over 12 different results, because I did it with Bitcoin USD, Bitcoin Korean Won, Bitcoin Euro, and they all reiterate the same result and same shape when I compared it with all the different stock markets. Okay, so overall, our main conclusion from this quantile-on-quantile regression is that Bitcoin, in terms of the definition that I gave you at the beginning, Bitcoin acts really good as a hedge and diversification, and it kind of acts also as a safe haven. So you can actually treat it like gold in terms of when the stock market is not doing well. Okay, so this is the result that I got from the quantile regression of Bitcoin USD. Now, what is the result when I regress this quantile regression on Facebook? Well, you can see from this result on diagram here, again, is slightly different from what I just saw previously. What I see here, well, before I tell you the results, let me just explain again quickly about the different axes. So tau here again, it is your quantile of your S&P 500. So your different quantiles. Here is the worst, here is the best scenario. Theta here, remember now I'm not caring about Bitcoin USD, I'm caring about the FANG stocks. And here I'm just illustrating Facebook return. Again, theta 0 or quantile theta, so theta 0 relates to the worst scenario of Facebook return, and a theta of 1 or large here relates to the best scenario of Facebook return, and beta 1 estimate is the coefficient of the quantile regression of your S&P 500. So what do we see here? Well, this kind of shows a kind of different results from what we just saw previously. This result shows that the S&P 500 market always acts positively related to Facebook return, no matter whether we're in extreme bull market or bear market or normal market. So what we can see is at all quantiles of returns of Facebook, the beta 1 estimate for all tau is always positively now. Can you see before it went negative here? But now you can see it's all positive and all greater than 0. So really, in terms of finance, this gives you a different definition. This tells you that these FANG stocks, and especially Facebook, it no longer acts as a safe haven or a hedge against stock market indices. What it does is, like we can see, that Facebook only acts as a diversifier against the S&P 500 or stock market indices. So we can see that in terms of financial interpretation, Facebook can't be really treated as a safe haven or hedge. It can only be satisfied as a diversifier against stock market returns. And again, this kind of shape plot from the quantile regression, again, is kind of same for if I tested it on the other FANG stock like Facebook, Google, Netflix, and I've forgotten the other FANG stocks now. But again, the results are all similar, and it produced the similar quantile-on-quantile regression plot. Okay. So finally, what is the discussion? So from our results, we really found a significant difference between the features of Bitcoin and technological stocks through the quantile-on-quantile regression results and their relation with the global stock market. What's more, as I just explained, from the quantile-on-quantile regression, we saw that Bitcoin can really act as a hedge, diversifier, and a safe haven against stock market. But we found that FANG stocks can mainly just act as a diversifier against global stock market indices. And this kind of result is kind of important if you are putting or trading Bitcoin or technological stocks in your portfolio. Okay. And finally, based on this result, we can see that investors do not really see Bitcoin as a technological or as a technology in terms of investment purpose. Okay. So our main conclusion is that although Bitcoin and high performance technological stocks, as I showed you at the beginning, has kind of same or similar properties in terms of its price, its technological advancements, its regulatory, and many more similarities, we can see really that Bitcoin exhibits significant difference with FANG stocks in terms of diversification properties against stock market indices. So the main conclusion is financial, or from a financial perspective, it indicates that we do not see, and investors really do not see or treat Bitcoin as a technology, but really when we trade it, we really just see it rather as a potential investment for financial gain based on the result of the quantile-on-quantile regression. So it really has a lot of diversification properties. Okay. So that's all from my talk today. Again, why I put this extra slide here. So as you all know, I'm not sure do you all know, I have for the last 2 or 3 years done a lot of research on blockchain and cryptocurrencies. And here are some of the research that I have also published on blockchain and cryptocurrency. So if you are interested in any of these research, as I say, I'm not only in finance or statistics, I'm also looking into like modeling the fraud behavior of the blockchain markets and looking into like the latest non-fungible tokens and also the DeFi markets. So if you're interested in any of these research areas, as I say, please feel free in contacting me. Okay. So, yep. Thank you very much.
Thank you, Stefan, for your talk.
Okay.
I will open for questions now.
Okay. I'll just
Any
stop.
questions, guys?
So you can see me?
Yes. Okay. Thank you,
Okay.
Stefan.
Yep.
I actually, I do have a question, a
Okay.
technical one.
Okay. Hope I can answer it.
I would take advantage of your expertise in extreme value theory.
Okay.
Could you please open your slide again and
Okay.
show me the picture, the first one and the second one?
Okay, let me just get back to there. Just give me a second. Okay, so let me open it up so you can see it full screen. So can you see the screen now, Michelle?
Yes, I do.
Okay. Just give me a second. Yeah. Okay. Which screen did you want?
The first picture and the second picture. Yes, this is a.
This one.
No, I'm sorry. That's the other one. The next one.
Sorry, this one.
Estimate. No, the picture estimate of the. Yes, this one.
Yep. Mm-hmm.
This looks quite stable to when theta is around 0.5, which should be expected because it will be close to the ordinary least squares estimate.
Yep.
And of course, as theta increases or decreases, this could change or not. In your case, theta changed reasonably well for values close to 1.
Yep.
But my question is more technical. But is this some kind of phenomenon based on some issues that usually we have when we are dealing with extreme values? Because I'm not an expert, but I read something about and I saw that the estimation methods, the usual estimation methods, they cannot be well applied to extreme value theory because they are not reliable. Is that true?
You kind of yes, as I say, even for us when I ran this result, I kind of, because this quantile regression result, or the result here that I got from the quantile regression, as I mentioned before, I kind of expected the results to be similar to the Pearson correlation matrix when you analyze it as a whole. So I kind of expected it to be the same.
Yeah.
But when we saw the results, or when me and my collaborator saw the results, we were kind of shocked with why at the upper, or especially it was for all cases, at the upper extreme quantile, there was a sudden spike in increase in the coefficient. So as I say, we weren't really sure. We had a look at the extreme cases, even Saulis, because he's into extreme values. He kind of had a look and tried to explain to us why he might have thought, but again, we couldn't really, because as you can see here, this is for the Bitcoin USD, but then for the Facebook, it kind of provided the opposite result for the stock market index. So again, this phenomenon, as I say, I couldn't really explain why, but we just, as I say, we just illustrated that this phenomenon could not be seen on a typical OS regression because you analyze it as a whole. But when you care about the upper extreme through this quantile regression, it was clear. And again, this result was also clear for all the different Bitcoin, Bitcoin Euro, Bitcoin Korean Won, and all the FANG stocks. This phenomenon did appear. Maybe it's to do with the asymptotic of the extremes when you're reaching extreme levels. But as I say, yes, to answer your question, we still, as I said, this phenomenon was quite strange. And we just treated it and took it as yes.
Yeah, it's very interesting. Actually, because especially in the next picture, as you just show, the estimates are very stable, right? The next one of the Facebook. Yes. No, actually, the before. Yes, this one, the before one.
Yep. The next one.
No, the 14th slide.
Oh, sorry, 14th. Okay. Yep.
Yes. This one. They're quite stable, right? Even for theta close to zero. So we could, if it was a phenomenon, some kind of unreliable phenomenon, I don't know how to call it, but it should happen something like this in the left, right? Close to zero, but it doesn't happen.
It doesn't happen, yes. So as I say, because Sam Lee ran these results, and when he got it, he says, he thought it would just be for specific cases. But as I say, we ran it with all the different combination resulted in similar results as here, but this phenomenon only appeared at the upper quantiles.
It's very interesting, especially because I guess when you're dealing with the Bitcoin or something like this, you have a strong volatility.
So yes, so we thought that this result, yes, because we know compare Bitcoin compared to Facebook returns, we know that Bitcoin has huge volatility, especially in up markets. So we thought that this is the only case. But again, when we ran the same result, we also saw this same result for Facebook. Yes.
Indeed, it just makes sense when you compare, when you use quantile regression, because of the volatility. I don't think it would make sense. Of course, for illustration, when you use the ordinary least squares regression, okay, you can illustrate, but you can see some answers, right? When you try some quantile regression. Very interesting.
Yeah, but as I say, the main thing, because even with this quantile regression, one can't really make much financial interpretation. That's why one had to move on to this quantile-on-quantile regression, which can allow one really in finance to compare, because this is what you really want to compare. Worst 10% scenario case, compare it with the best 10% scenario case. So at different quantiles between your independent and your dependent variable. So hence why we plotted this quantile-on-quantile regression.
Yeah. And it's because my question was just because in this picture, you take a look at it and you'll see, okay, we have behavioral that you can call okay. You can explain, but the other one it call attention, right? The estimate just explode. It's,
Yes.
that's because that's why
Yeah.
I asked you, but
Yeah.
okay. But,
well, it's definitely a thing. I'll definitely look back into it and see, or have a look in research, see what else when people running this quantile regression. Is this phenomenon also seen in different assets and stuff? I may have a look at that as well. So yes.
Nice.
Yeah.
Anybody else want to?
I have a question.
Okay.
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 Steph, my question is personal.
Okay.
Bitcoin look like a good investment. Have you ever invested in Bitcoin?
When I came a couple of years ago, when I was in Brazil, I had little, but I cashed out. Most of all my work now is all on research. It's, as I say, in the last 5 years, it's all on research on blockchain and cryptocurrency. So, and as I say, I kind of like doing because back in those days, 3 years or 4 years ago, the research literally no one really did much research on blockchain or cryptocurrency. But as I say, within the last 5 years, you have seen, even if you look at the trends of Google Scholar and citation on the word blockchain or cryptocurrency or Bitcoin, it has suddenly exploded in the last 2 to 3 years. Yeah. So for me, it's mainly research perspective.
It's possible to think about this idea to invest in Bitcoin. And
it's kind of one could say now investment purpose is more for these big investment banks. As you can see lately, as you can see Tesla investing, and a lot of investment banks in Europe and even in Dubai, a lot of them now they're investing, but they're putting a large percentage of investment in Bitcoin into their portfolio.
But do you recommend?
I don't know. 5 years ago, yes, when I came to Brazil, but now the price is nearly about 50,000. Because if you think about 50,000, if it did go up to 100,000, it's only 100%. If you compare about other financial products in the market, there's a chance of an increase in other financial products in the market now than what you can see return.
These other financial products do not have this volatility, right?
No, definitely not.
Yeah, I think we still have room for some increasing, right? Especially now because several artists are making some kind of advertisement about cryptocurrencies, especially Bitcoin.
Yeah, so everything will go up and the bull market will continue to go, but where it will kick in is when countries start bringing in bans, like what happened in 2018. As soon as countries start banning it, I think like 2 months ago, I think India was talking about banning it, or some countries. Any negative connotations on this, it caused the market to turn slightly. So, but in hindsight now, I think it will slowly continue to increase, because as I can see here in Europe, UK, and even Dubai here, a lot of investment banks are slowly investing, but these are more institutional investment banks.
Another question, does this method of analysis capture the sensitivity of Bitcoin return? For example, in relation price of gold, because there are volatility. How do you say, Michel? Volatility. Yeah. Gold, for example, price of gold is different. There is the quantile capture the sensitivity.
Well, I think the quantile. Well, the ORS and quantile regression is kind of weak. It doesn't really capture the sensitivity of volatility. But the quantile-on-quantile one, because you're modeling the different quantiles, and you're modeling it based on your return data, it kind of, well, you can't say it models it really well, but it is definitely a step up to the typical ORS and quantile regression. So yes, the quantile-on-quantile regression itself is kind of a good model to explain your question just then. Yes, Vera.
Because I saw in the future research you intend to research about the time serial times. It's better.
Okay, let me do.
Because serial times there is a.
Sorry. Yes, on this diagram here. Yep.
Okay.
You're talking about this graph, yeah? Yep. So you can't see here. So did you say there's literally zero? You can get zero quantile, but because when I'm plotting this 3D image, it's kind of, I had to illustrate it neatly, so I can turn this diagram round. But here I just did a screenshot. Is that what you're saying? Are you saying that you can't see the zero quantiles, or what was your question? Sorry.
Okay, thank you. Nice presentation.
Okay. Yeah. Okay. I think you muted, Michelle.
Okay, I'm sorry.
No.
Vera, did he? Are you? Is it clear now to you, Vera?
I finished.
Okay. Anybody else? Any more questions?
I have a curiosity. It's not a question.
Okay.
I was. Why did you choose this particular cryptocurrencies, and do you intend to extend this analyze to other cryptocurrencies?
Okay. So why I chose Bitcoin, because as I say, most research, because Bitcoin is the greatest in terms of crypto, in terms of the cryptocurrency market capitalization, and like Bitcoin represents, like at the moment, if you check the market capitalization, it represents like I think 60 or 70% of the whole cryptocurrency market. So that's why I only did it on Bitcoin. That's to answer that question, because it gives the best representation of cryptocurrency. And secondly, if I started to do it with loads more other cryptocurrency, you already saw based on the ORS regression, and as I showed you here, these are the graphs from the quantile-on-quantile regression was only 1 or 2 graphs from 72 different plots. If I did it with more different cryptocurrency and different exchange, there'll be over 200 graphs, and that would be too much personally. I'll probably have to put all of it in the appendix when I submit it to a journal. Yeah.
Okay, thank you.
Yeah. So yes, there is possibility to extend it, but I personally think the results will be the same, because as I say, when Bitcoin moves up, so does mostly all the other cryptocurrency moves up, and when it goes down, vice versa. So I kind of expect the results to be similar, but yeah, it'll be good to, if you have a look and try it with others. If it's different, then that'll be interesting. Yep.
Professor Shan.
Yes.
Well, I have a question.
Yes.
First of all, let me say it's a wonderful presentation. Great. I thought it was really great. It's just a curiosity over here. Have you ever thought about using mixture models in which the different hidden states could represent different conditions of the market to model quantile-on-quantile regression?
So you're saying, firstly, fit a mixture distribution onto the return data and then fit the quantile-on-quantile regression. Is that what you're saying?
Yes, sir. That's what I'm saying.
So my first ever paper was I presented at your university 2 or 3 years ago, was a statistical analysis of Bitcoin. So back then, when I fitted over 15, 20 different distributions, or distributions where there's heavy tail, light tailed, onto Bitcoin returns. And I found that the best distribution, and I extended this to every different cryptocurrency, that the best distribution always to model cryptocurrency itself is the generalized hyperbolic distribution, because it has 5 parameters and it's really good at catering for the heavy tails, and it can model the lower and upper tail. So hence, that so far is the best distribution that I found to model all cryptocurrency. Regarding mixture models, I haven't applied mixture models. But I have seen in last year, there has been quite a lot of research also on mixture models, but comparing mixture models to the fitting of the generalized hyperbolic distribution, I'm not sure. That's something one could have a look at. But yes, for me, I found in early days that Bitcoin and all other cryptocurrency, the generalized hyperbolic distribution, which is a 5-parameter distribution, is the best fitting model to model cryptocurrency that we have found.
Right.
And based on that distribution, a lot of people have used that distribution to fit it into the innovation process when you're doing Gauss process or time series forecasting. Yeah.
Right, right. I just I
model
thought
is
about
something-
it.
Yes, it's definitely something.
Oh, sorry.
Sorry, good stuff. You speak first.
Oh, sorry, sir. I was just curious about that because it's a temporal phenomena, and time series. Mixture models are very good in fitting these type of phenomena, right? That data from these types of phenomena, right?
True, yes. And as I say, based on what you said, even in insurance purposes, there's a lot of mixture model used in insurance data. So yes, it's definitely something to look into, using mixture models on cryptocurrency. If you have a look at Google Scholar, I think there has been, especially recently, I did see a couple of people using or starting to use mixture model or composite models to model cryptocurrencies. Yes. Mm-hmm.
Right. Thank you very much, Professor. Great presentation. Thank you.
Thanks. Okay.
Anybody else? Well, I think that's it. Just 1 second, please. I will stop the recording and then I will close this presentation. Just 1 second.
Michelle?